Hello and welcome to this special report here at XM.com. The Japanese government officially nominated Kazuo Ueda on February 14th to become the Bank of Japan's next governor. What will this mean for the financial community on a national and international level, and how might it impact the yen? I'm Maria Pachurdes, and joining me to discuss all this is senior investment analyst Haruhiko Kuroda. So Haruhiko, everyone is keen to learn more about Kazuo Ueda and how the Bank of Japan's policy direction might change under his leadership. Can you tell us a bit about Japan's current economic situation and what Ueda's governorship could mean for the Bank of Japan?
Hello, Maria. Kazuo Ueda is an academic with a PhD from the MIT. People who know him say that he's a pragmatic policymaker type academic who will be willing to adjust very flexibly according to the needs of the Japanese economy. They say that he's a listener and a consensus builder rather than a chief with a strong view on monetary policy. That, in my opinion, makes it hard to categorize him as a hawk or a dove. Now, in a column he published in July, Ueda argued against raising interest rates prematurely, but he highlighted the difficulty of maintaining yield curve control as inflation bites harder. And he also pointed to the flaws of this policy. So this can be taken as a first sign that he may not be in a rush to take interest rates out of negative territory, but also that he may not hesitate to scrap the yield curve control policy entirely should the economic state warrant so. Now, speaking about the economic state, Japan's economy dodged a recession in the fourth quarter as it returned to expansion after contracting in the third quarter. However, growth was slower than expected as business investment slumped, suggesting that phasing out easy monetary policy conditions may not be an easy task for the Bank of Japan. Having said that though, inflation accelerated to 4% in December in both headline and core terms, which is double the Bank of Japan's objective of 2%, and it was the highest in 41 years. On top of that, judging by the Tokyo CPIs for January, both rates may continue drifting north. Now, the elephant in the room, however, may be the surge in the total cash earnings for December, where we saw wages surging by 4.8%, the fastest pace in 26 years. And this led to the first increase in real wages since March, despite accelerating inflation. So, putting everything together, flying inflation and accelerating wages are a cocktail that warrants scaling back more accommodation, and that was the case even before the Shunto wage negotiations that started on January the 23rd. Now, should firms agree with unions on pay increases, speculation that the Bank of Japan may need to make another move towards normalizing its policy may substantially increase.
Okay, turning to the Japanese currency now, what reaction might we see in the yen if the Bank of Japan puts an end to its yield curve control policy?
Now, ending the yield curve control policy is obviously a positive development for the Japanese currency, as with inflation still in accelerating mode, Japanese government bond yields will likely rally above the current bound of 0.50%. Having said that, though, traders may add fuel to the yen's engines well before such a decision is made by policymakers, perhaps only on speculation that this may be the case at some point in the not-too-distant future. Now, should Ueda become more vocal about the difficulty of maintaining a yield curve control policy as he gets closer to taking the position at the Bank of Japan, the yen may start staging a recovery. However, whether the prevailing downtrend in dollar-yen could resume remains a mystery. One of the reasons is that the dollar has been enjoying gains lately as investors substantially raised their implied path with regards to the Fed's future course of action, And on top of that, China's reopening and estimates that the Eurozone may have averted a recession have kept risk sentiment supported and thereby the safe haven yen on a weak note. From a technical standpoint, for the prevailing downtrend in dollar yen to continue, a clear dip below 127.20 may be needed, as this will confirm a lower low. Now, in case Ueda's language is interpreted as more dovish than expected in the months to come, dollar yen may extend its latest recovery, and a break above 134.80 could allow advances towards the key resistance territory of 138.
All right, Lumbus, thanks so much. And thanks for joining us for this special report here at XM.com.